areas in accountancy and showing you why these rules really matter out there.
And I'm Grace, ready to take that journey with you, dive in deep into the mechanics, the legal stuff, and the step-by-step process of, well, closing the books for good. We are Adam and Grace, your passionate educators here at School on X.
Today we are taking a really deep dive into one of the most critical topics in grade 12 accountancy. It's kind of the end game, isn't it?
It really is. We're talking about the dissolution of a partnership firm.
Yeah, the economic and legal death of a business structure. And, the pretty rigorous process you have to follow to make sure every single rupee is accounted for.
Our mission today is basically to take this topic, which can seem a bit daunting with all its rules, and turn it into something clear, something you can actually, visualize.
Right. We need to nail down that fundamental legal difference first.
Definitely. And then understand the 5 ways a firm can legally cease to exist. And then spend a good chunk of time really mastering the main accounting tool that makes it all happen, the realization account.
Okay, so let's kick off with that big idea, the one that often throws people off right at the start. Imagine this. You've got 3 partners, A, B, and C. They run a bookstore, it's doing okay. Now, A and B decide they want to change how they split profits. Or maybe A just retires, leaves the business, but B and C keep it running. The shop's still open, same name, same staff. Wait, what? How is that dissolution?
Ah, perfect example. That brings us straight to probably the most important distinction you need to get your head around today. The difference between the dissolution of a partnership and the dissolution of a firm.
Yeah, because those words sound so similar, don't they? Partnership, firm.
They do, and that's where the confusion starts. But legally, financially, they are completely different concepts. Let's define the first one, dissolution of partnership.
Okay, this one sounds dramatic, but you're saying it's often not at.
Often not. No, it's more like an administrative change. When we talk about dissolving the partnership, we're really talking about a reconstitution.
Reconstitution, like rebuilding.
Sort of. It just means a change in the existing agreement or relationship between the partners. Think of the partnership as that specific contract between A, B, and C in your example.
Okay.
When A retires, or they change the profit-sharing ratio, that specific contract is dissolved, yes, but a new one immediately takes its place between the remaining or continuing partners. The firm itself, the actual business, the bookstore, it keeps going.
Ah, I see. So if Rita and Gita are partners and they bring in Ashish, the old Rita-Gita partnership ends.
Exactly. That agreement is gone.
But the business, the shop, the brand, the customers, that firm is still trading the next day.
Precisely. No interruption. That's why things like admission of a partner, retirement, death, and impairment, they all fall under dissolution of partnership. They change the relationship, dissolve the old agreement, but the firm itself usually continues.
Okay, so what else counts as dissolving just the partnership?
Well, besides admission, retirement, death, there's a change in the profit-sharing ratio, like in your first example. Also, if one partner becomes insolvent, that can dissolve the partnership. Or if the partnership was set up for a specific project, like building one bridge, completing that project dissolves the partnership.
Right, or if it had a fixed end date.
Exactly, expiry of the term. All these change the internal agreement, but the external business entity might carry on.
Okay, that makes sense. Now, let's talk about the big one, the final act, dissolution of the firm. Section 39 of the Act, right?
That's the one. Section 39 defines it clearly. Dissolution of the firm means the dissolution of the partnership between all the partners.
All of them. So this is it. Curtains down.
This is the true end. The business entity ceases to exist. And the absolute key difference here is no business is transacted after this point. Nothing. Except
the winding up stuff. Selling things off, paying bills.
Exactly. Selling the assets, paying the liabilities, closing the bank accounts. That's all you can do.
So this is probably the biggest takeaway for you listening right now. If the firm dissolves, the partnership between everyone automatically dissolves too. You can't have a partnership without a firm.
Makes sense, right? If the business is gone, all the agreements within it have to end.
But, and this is the crucial part, dissolving a partnership, like when someone retires, does not automatically mean the firm dissolves.
Absolutely not. The firm can, and often does, continue. That's the core legal distinction.
And from our perspective as accountants, how does this look different in the books?
Oh, it's night and day. When a firm dissolves, the business is terminated, finished. So we sell the assets, we pay off the liabilities, and critically, the books of account must be closed. Forever.
Like you literally close the ledger, done.
Done. But when only the partnership dissolves, remember, reconstitution of the business continues. We don't sell the assets. Instead, what do? We
revalue them.
Exactly. We revalue assets and liabilities. We calculate new capital balances, maybe deal with goodwill, and prepare a new balance sheet for the continuing firm. The books stay open.
It's like the difference between rearranging the furniture in a house versus knocking the whole house down.
That's a great analogy. One is internal reorganization. The other is complete demolition and clearance. Understanding that difference is step one before we even talk about how a firm actually gets demolished, legally speaking.
Right. So The partners have decided we're done, or maybe something external forces their hand. How does a firm legally die? Let's walk through those 5 modes from the Partnership Act.
Okay. We can sort of group them by how much control the partners have, starting with the nicest way out, I suppose. Mode number 1, dissolution by agreement.
The friendly breakup.
Pretty much. It happens in 2 ways. Either all the partners just agree right there and then, okay, let's stop. Simple consent.
Unanimous.
Has to be.
Right.
Or, and this is important, it happens according to a clause already in their partnership agreement. Maybe the deed they signed on day 1 said, this partnership will automatically dissolve on December 31st, 2025.
So it's pre-planned.
Exactly. Both scenarios fall under by agreement. That's when the partners are basically in control of the timing.
Okay. But what if it's not their choice? What if something forces the closure? That sounds like mode number 2, compulsory dissolution.
Yes, this is where the law effectively steps in and says, you must stop. Usually because continuing the business has become illegal or impossible. There are generally 3 triggers here.
First one sounds like people going broke.
Essentially, yes. If all the partners become insolvent, or even all but one become insolvent, an insolvent person can't legally contract, and a partnership is a contract. So if there's no one left, or only one person left, who can legally be in the contract,
The contract has to end, the firm has to dissolve. Makes sense. What's the second trigger?
that's when the business itself becomes illegal. Imagine they were trading in something that the government suddenly bans.
Right. Obvious one.
And the third one is a bit more nuanced. It's when some external event makes it unlawful for these specific partners to carry on the business together, even if the business activity itself is still legal.
Ah, this is the alien enemy thing you mentioned.
That's the classic example, yes. Let's say you have a partner who is a citizen of country X. If India declares war on country X, that partner instantly becomes an alien enemy in the eyes of the law.
Okay.
You can't legally be in partnership. You can't transact business with an alien enemy. So the partnership must dissolve. Even if their business was, say, selling chai, which is perfectly legal, the relationship becomes illegal.
Wow. It's amazing how global politics can just shut down a local partnership like that. Okay, moving on. Mode number 3, dissolution on the happening of certain contingencies.
This one often links back to the partnership agreement again. That phrase subject to contract between the partners is key here.
Meaning the partners can decide in advance if these events will kill the firm.
Exactly. So common contingencies are, if the firm was set up for a fixed term, say 5 years, it dissolves when those 5 years are up.
Okay.
If it was for a specific venture build, one specific building, it dissolves when the building is finished.
Right.
Now, death of a partner or insolvency of a partner, normally these just dissolve the partnership. Reconstitution, right?
Yeah, that's what we said earlier.
But the partners could write into their original deed, if any partner dies, the entire firm shall be dissolved. If they put that in the contract, then death does trigger firm dissolution under this contingency mode.
So that subject to contract bit is super powerful. It lets them customize their own dissolution rules for these events.
It really does. Okay, mode number 4. This one only applies to a very specific and sometimes quite fragile type of partnership. Dissolution by notice.
And this is only for a partnership at will.
Correct. A partnership at will is one where there's no fixed duration agreed upon, and it wasn't formed for one specific project. It just exists.
Sounds a bit precarious.
It can be. Because in a partnership at will, any single partner can decide to end the entire firm. All they have to do is give written notice to all the other partners saying, I intend to dissolve the firm.
Just like that. One partner can pull the plug on everyone.
Just like that. It's an immediate unilateral power. Shows why having a clear term or venture in your partnership agreement gives a lot more stability.
No kidding. Okay, finally, the one that probably involves lawyers. Mode number 5, dissolution by court intervention.
Yeah, this is when things have usually gone quite wrong internally, and one partner asks the court to step in and order the dissolution. The court won't do it lightly, though. There have to be specific grounds.
Like what would make a court dissolve a firm?
Several things. If a partner becomes, say, permanently insane, or otherwise permanently incapable of doing their job as a partner, it's unfair to expect the others to carry them forever.
Makes sense.
Or if a partner is guilty of serious misconduct that's likely to damage the business. Think embezzlement, persistent fraud, maybe constantly ruining the firm's reputation.
Bad behavior.
Or even just persistently breaching the partnership agreement, if they keep breaking the rules they agreed to.
What if a partner tries to sell their entire share to an outsider without asking the others?
That's another ground. If a partner tries to transfer their whole interest, undermining the trust basis of the partnership, the court can dissolve it.
And what about the money side? If the business is just losing money hand over fist?
Crucially, yes. If a partner can prove to the court that the business cannot be carried on except at a loss, the court can order dissolution. It recognizes that forcing partners to keep pouring money into a failing venture isn't sustainable.
Economic reality check from the court.
Exactly. And then there's a sort of catch-all.
Yes.
The court can dissolve the firm on any other ground that seems just and equitable. This gives the court flexibility for really unusual situations where dissolution is clearly the fairest outcome, even if it doesn't fit the other specific categories.
Okay, so those are the 5 ways the legal end can happen: agreement, compulsion, contingency, notice, or court order. Once that trigger is pulled, the financial cleanup starts.
And that brings us right to the heart of the accounting, the settlement of accounts, governed by Section 48 of the Partnership Act, 1932.
This is where accountancy really becomes the rule book for fairness, isn't it? It's not just about adding and subtracting. It's about a legally mandated order of who gets paid, when, and from what source.
Absolutely. Section 48 lays out 2 critical hierarchies. First, how do we deal with any losses? Second, in what order do we apply the money we get from selling assets?
Let's tackle the losses first. Part A, treatment of losses. If the whole winding up process results in a loss, or if partners end up owing the firm money, a debit capital balance, where does that money come from? There's a strict order.
There is. First dibs is profits. If the firm has any accumulated profits or reserves sitting there, the losses get paid out of those first.
Use the firm's own past earnings first. Logical. What if that's not enough?
Step 2, you use the partner's capital, the actual money they invested. You reduce their capital balances to cover the remaining loss.
Okay, profits first, then capital. What if even the capital is wiped out and there's still a loss remaining?
Then, step 3, the partners have to personally pay up. They must bring in cash from their own pockets individually to cover the final shortfall, and they contribute this cash in their profit-sharing ratio.
Oof. That's the unlimited liability aspect really biting, isn't it?
It absolutely is. That's the order for absorbing losses. Now, the flip side, Part B, application of assets. This is about the money coming in from selling the assets, plus any cash the partners had to bring in to cover losses. How is that pool of cash distributed? Again, a strict order.
And this order is designed to protect who first?
Outsiders. Non-negotiable priority number 1, paying the debts of the firm to third parties.
So everyone external, suppliers, the bank.
Exactly. Sundry creditors, bank overdrafts, bills payable, outstanding expenses, any loans from people who aren't partners, they get paid first.
Why is that so absolute? Why before the partners get anything back?
It's about protecting the commercial system. Those third parties dealt with the firm in good faith. The law ensures they get their money back before the owners, the partners, start trying to recoup their own investments or loans. Within this group, by the way, secured creditors, like a bank with a mortgage on the firm's building, usually get paid before unsecured creditors.
Okay, so third parties are fully paid. Phew. Who's next in line for the cash?
Priority number 2, paying back any loans or advances made by partners to the firm.
Ah, so a partner's loan gets paid back before their capital.
Yes, this is a critical distinction. A loan from a partner is treated differently from their capital contribution. The law sees it as the partner acting more like an external financier in that specific instance, so their loan ranks higher than their capital investment.
So if partner A loaned the firm 50,000 rupees and partner B has 50,000 in capital, if there's only 60,000 cash left after paying third parties.
Partner A gets their full 50,000 loan back first, partner B gets the remaining 10,000 towards their capital, and the rest of their capital is lost, unless more cash comes in later. The loan takes precedence.
Wow, okay. Important difference. So third parties, then partner loans. What's priority 3?
Priority 3 is finally paying back the partner's capital contributions. Whatever cash is left at this stage is distributed among the partners proportionally based on what's due to them on account of capital after adjusting for their share of any losses or profits on realization.
And if, by some miracle, there's still cash left after paying third parties, partner loans, and partner capital in full.
That remaining amount, the residue, is pure profit from the dissolution process. And that surplus is divided among the partners in their profit-sharing ratio.
That order, third parties, partner loans, partner capital, residue, is absolutely set in stone by Section 48.
Set in stone. Now, closely related to this is Section 49, which deals with a potential conflict, private debts versus firm debts.
Right. What happens if the firm is okay, but one partner is personally bankrupt? Or vice versa? Whose creditors get paid first from which pot of money?
Section 49 clarifies this to prevent partners from, say, using firm assets to pay off their personal credit card bills before the firm suppliers get paid.
Makes sense. So what's the rule?
The rule is, firm property pays firm debts first. Only if there's a surplus of firm assets after paying all firm debts can that surplus be used to pay the private debts of a partner.
Okay, firm assets protect firm creditors first, and the other way around.
The counter rule. A partner's private property pays their private debts first. Only if a partner has a surplus in their personal assets, after paying all their personal debts, can that surplus be used to pay the firm's debts, and importantly, only if the firm's own assets weren't enough.
So there's a clear separation, a firewall almost, between the business's finances and the partner's personal finances when it comes to creditors.
Exactly. And a quick but important note here. When we say private property of a partner, it does not include the personal property of their spouse or children. It's strictly the partner's own assets.
Good clarification. Now, connected to all this paying back and potential shortfalls, you mentioned capital deficiency earlier, and the Garner versus Murray case. This sounds like a really specific, important rule.
It is. It's a classic case from 1904 in England. But the principle it established is still relevant, especially when one partner becomes insolvent during the dissolution and can't pay back what they owe to the firm.
So a partner ends up with a debit balance in their capital account, meaning they owe the firm money, but they're personally bankrupt and can't pay it. What happens then? Who covers that loss?
That was exactly the issue in Garner versus Murray. They had three partners, Garner, Murray, and a third partner, Keene, who became insolvent and couldn't cover his capital deficit.
So Garner and Murray, the solvent partners, had to cover Keene's shortfall.
Yes, but the crucial question was, how should they share that burden? Should they share Keene's deficit based on their usual profit-sharing ratio?
That sounds like the logical way to share any loss, doesn't it?
It does seem logical, but the court said no. The court decided that the loss arising from an insolvent partner's capital deficiency is not an ordinary business loss or a realization loss. It's a specific type of loss, a capital loss.
Ah, okay, a capital loss. And how are capital losses shared, according to Garner versus Murray?
They must be borne by the remaining solvent partners, not in their profit-sharing ratio, but in the ratio of their last agreed capitals before the dissolution. Usually this means the capital shown in the balance sheet just before the dissolution process began.
Wow. So the ratio for sharing this specific type of loss changes from the PS ratio to the capital ratio of the solvent partners. Why did the court decide that?
The reasoning is a bit complex, but it essentially relates to ensuring that the burden falls on the partners based on their stake, capital, in the firm when this capital-related crisis hits. It prevents a partner with high profit share but low capital from bearing a disproportionate burden of a capital loss. It's considered more equitable in this specific insolvency scenario.
Unless the partnership agreement says otherwise.
Precisely. The partners can always agree on a different method in their deed. But if the deed is silent, Garner versus Murray applies. Insolvent partners' capital deficiency is borne by solvent partners in their capital ratio, often called fixed capital ratio, though sometimes adjusting capital is used depending on the exact circumstances and agreement.
Okay, that's a really important detail for handling insolvency within the dissolution. It ensures the books can eventually balance even when someone can't pay up.
Exactly. It's a mechanism to finalize the closure.
Right, so we've got the legal reasons for dissolution, the strict order for paying everyone off, Section 48, and the specific rule for insolvency, Garner versus Murray. Now, let's get practical. How do we actually do the accounting? We need to talk about the realization account.
The realization account. This is it. This is the central hub, the accountant's crucible, as you called it earlier, for the entire winding up process.
Crucible, I like that. A place where everything gets melted down and sorted out.
Pretty much. Think of it as a temporary account. We open it just for the dissolution. Its sole purpose is to calculate the overall profit or loss that arises specifically from selling the firm's assets and paying off its external liabilities.
So it isolates the financial result of just the closing down sale, basically.
Exactly. It helps us figure out if we made a gain or loss on that final garage sale.
How does it work mechanically? What goes in, what comes out?
Okay, first step. We need to empty the relevant parts of the final balance sheet into this new account. We start by transferring balances. On the debit side of the realization account, we transfer all the firm's assets, listing them individually at their book values, the values they have in the balance sheet just before dissolution.
All assets, like everything.
Almost everything. There are three key exceptions. You do not transfer cash in hand, cash at bank, or any fictitious assets.
Why not cash and bank?
Because cash and bank aren't assets realized in the same way. They are the realization. They're the medium of settlement. We use the cash pick account to track the actual money flowing in and out during the process.
Okay, and fictitious assets, like a debit balance in the P&L account.
Right, or things like deferred revenue expenditure. These aren't real assets you can sell. They represent past losses or expenses not yet written off. They get dealt with separately by debiting them directly to the partner's capital accounts.
Got it. So debit side of realization gets all tangible and intangible assets except cash, bank, and fictitious ones. At book value, what about sundry debtors? They often have a provision against them.
Good point. Sundry debtors must be transferred to the debit side at their gross value.
Gross. Not the net amount after deducting the provision.
No, the gross amount. So if debtors are $100,000 and provision for doubtful debts is $5,000, you debit realization with the full $100,000.
Why?
Because the provision for doubtful debts is technically like a liability or a contra asset reserve. We need to close it out too, and we do that by transferring it to the other side of the realization account.
Ah, okay, so that brings us to the credit side of the realization account. What goes there?
On the credit side, we transfer all the external liabilities of the firm, again at their book values.
External liabilities.
Yeah.
So creditors, bills payable.
Yep. Sundry creditors, bills payable, bank overdraft, outstanding expenses, loans taken from outside parties, including loans from, say, a partner's spouse, like a Mrs. Partner's loan. That's considered external.
But not a loan from a partner themselves.
Correct. A partner's loan account is handled separately, paid off directly via the bank account according to Section 48, priority, not transferred to realization.
Okay, so credit side gets external liabilities. And what about those provisions we mentioned, like the provision for doubtful debts?
Exactly. Provisions like the provision for doubtful debts or maybe an investment fluctuation reserve. If investments are being realized, these are also transferred to the credit side of the realization account.
Why credit them there?
Think about it. These provisions were created out of past profits to cover potential future losses. But now the firm is dissolving. There is no future. By crediting them to realization, we're essentially reversing them, adding them back to the pot, which increases the final profit, or reduces the loss, distributable to the partners.
Okay, that makes sense. So step 1, transfer assets, gross, ex cash bank fictitious, to debit. Step 2, transfer external liabilities and provisions to credit. Now, the realization account holds the book values of everything to be settled. What's next?
Step 3, record the actual realization, the selling of assets and paying of liabilities when an asset is sold for cash.
Cash comes in. So bank account debit.
Correct. Bank AC is debited, and the realization account is credited with the amount actually received. The journal entry is Bank AC Doctor to Realization AC Ch04. We credit realization because the asset, which was on the debit side, is now gone, replaced by cash, and this credit records the inflow from that disposal.
Okay, and when we pay off a liability or pay those winding up expenses?
Cash goes out. So bank account is credited, and the realization account is debited. The entry is Realization AC Doctor to Bank ACR. We debit realization because paying the liability, which was on the credit side, uses up resources and represents an outflow related to the winding up.
Got it. So cash in from asset sales, credit realization, cash out for liabilities, expenses, debit realization.
Exactly. You keep doing this until all assets are sold or taken over by partners, which we'll get to, and all liabilities and expenses are paid.
And then the moment of truth.
The moment of truth. You total up the debit side and the credit side of the realization account. If the credit side total, what we got in, plus liabilities provisions transferred, is more than the debit side total, assets transferred plus what we paid out.
Credits exceed debits. That's a profit, a realization profit.
Precisely. And that profit belongs to the owners. It's transferred to the partners' capital accounts, credited to them in their profit-sharing ratio.
And if the debit side total is higher?
Debits exceed credits. That's a realization loss. That loss also belongs to the owners, so it's transferred to their capital accounts, but this time it's debited to them, again, in the profit-sharing ratio.
So the final balance of the realization account tells you the net financial result of the entire closing down sale and settlement process. And that result gets shared by the partners.
That's its whole job. It's the final income statement in a way, just for the dissolution itself.
Okay, the basic mechanics seem clear. Transfer assets. Doctor, transfer liabilities provisions, CR, record cash and CR record cash out. Doctor, find the balance. Profit CR to capital, loss doctor to capital. But life's rarely that simple, is it?
Rarely. The real test often comes in handling the exceptions, the non-standard transactions.
Like when partners get involved personally, taking assets or paying debts.
Exactly. Or unrecorded items popping up. Or those tricky realization expenses. We need to nail the journal entries for these specific scenarios.
Okay, let's unpack those. First big one. What happens if, instead of selling an asset for cash, a partner decides to take it over themselves? Maybe they want the office computer for home.
Right. If a partner takes over an asset, the firm essentially treats it as if the partner bought it from the firm. But instead of paying cash, the payment is handled by reducing the amount the firm will eventually pay back to that partner.
So you debit their capital account.
Exactly. You debit the partner's capital account with the agreed value at which they are taking the asset, and you credit the realization account.
Why credit realization?
Because, just like selling the asset for cash, the asset, which was on the debit side of realization, is now disposed of. The credit to realization records the value received for it, even though the value came via the partner's capital adjustment, not cash.
Give us an example. Say Nyana takes over half the stock. Book value of total stock was $50,000. She takes her half, book value $25,000, but at a 10% discount.
Okay, so 10% discount on $25,000 is $2,500. She takes it for an agreed value of $22,500. The entry would be Nyana's Capital AC Doctor $22,500 to Realization ATCR $22,500.
Got it. Reduces her claim, clears the asset value from realization. Now the opposite. What if a partner agrees to pay off one of the firm's liabilities? Say, Supriya agrees to pay the sundry creditors of $15,000.
Okay, in this case, the partner is doing the firm a favor by taking on its debt. The firm now owes that money back to the partner instead of to the original creditor.
So the firm's overall liability hasn't disappeared, it's just shifted to the partner? How do we record that?
We debit the realization account with the amount of the liability taken over because the external liability, originally credited to realization, is now settled from realization's perspective. And we credit the partner's capital account, increasing their claim against the firm because the firm now owes them that $15,000.
So for Supriya taking the $15,000 creditors, Realization Act Dr. $15,000 to Supriya's capital ACR $15,000.
Perfect.
Okay, now for my favorite confusing one, the famous or infamous no entry rule, particularly when a creditor takes an asset directly.
Oh, yes, this catches so many people out because it feels like something should be recorded.
It really does. So the scenario is we have a creditor owed, say, $10,000, and we have plant and machinery on our books already transferred to realization debit side. The creditor agrees to take the plant and machinery in full and final settlement of their $10,000 debt.
What's the entry?
The entry is nothing. No journal entry is made in the realization account for this specific exchange. But wait. We transferred the plant, say book value was $12,000, to the debit side of realization. We transferred the creditor, $10,000, to the credit side. Now they've canceled each other out, but we don't record that cancellation. How does realization balance?
Think about the purpose of realization account. It's to calculate the cash profit or loss on disposal. When a creditor takes an asset directly, there's no cash changing hands for that exchange. The liability is settled, the asset is disposed of. They offset each other outside the cash calculation.
So the logic is the debit for the asset and the credit for the liability just sit there in realization, effectively canceling each other out without needing a specific settlement entry between them.
That's the convention, yes. We assume the asset was disposed of for exactly the amount of the liability settled, in this case $10,000, resulting in zero cash profit or loss from that specific swap. It simplifies the calculation of the overall cash result.
Okay. It feels weird, but I get the logic if the goal is purely cash P&L. But what if cash is involved in the swap?
Well, that changes everything. If there's any cash movement, the cash part must be recorded.
Example, creditor owed $10,000, takes an asset, and say book value $8,000, and accepts it as full settlement. Still no entry.
Still no entry for the asset liability swap itself.
Okay, but different example. Creditor owed $10,000, takes an asset, book value $8,000, and the firm pays them $2,000 cash to fully settle the $10,000 debt.
Right. Now cash is involved. The asset liability swap itself still generates no entry, but the cash payment does. We record the cash going out. Realization Act Dr. 2000 to Bank ACR 2000.
And if the asset was worth more, creditor owed $10,000, takes an asset, book value $12,000 in full settlement, and the creditor pays the firm $2,000 cash difference.
And then we record the cash coming in. Bank Act Dr. 2000 to Realization ACR in 2000. The core principle is direct asset for liability swaps are ignored in realization entries unless there's a cash component, in which case only the cash component is recorded.
Okay. Tricky, but the only record the cash difference rule helps. Let's move to another headache. Realization expenses. The costs of winding up auctioneer fees, legal costs, etc. The key here seems to be distinguishing who pays versus who bears the cost.
Absolutely. A critical distinction. Let's take the simplest case first. Scenario 1. The firm incurs the expenses and the firm pays them from its bank account.
Okay. Firm bears the cost, firm pays the cash. Simple.
Simple. It's an expense of winding up, so we debit realization account. Cash goes out, so we credit bank account.
Yeah.
Entry. Realization Act Dr. to Bank Act QCR. Let's say $5,000.
Makes sense. Scenario 2. The firm is supposed to bear the cost, but a partner pays it temporarily out of their own pocket, maybe because the firm's bank account was frozen or something.
Right. The firm still bears the cost, so realization account must be debited. Realization Act Dr. 5000. But the cash didn't come from the firm's bank. It came from the partner. The firm now owes that partner the money back.
So you credit the partner.
Exactly. You credit the partner's capital account. Entry. Realization Act Dr. 5000 to partner's capital ACR 5000.
Okay. Firm bears cost, debit realization. Firm pays, credit bank. Partner pays, on firm's behalf, credit partner's capital. Got it. Now, the really convoluted one. Scenario 3. A partner agrees to handle the entire dissolution process themselves. In return, the firm agrees to pay that partner a fixed remuneration, say $10,000. The partner, in turn, agrees to bear all the actual realization expenses personally, whatever they might turn out to be.
Okay, this needs 2 steps. First, we have to record the remuneration the firm owes the partner for doing the work. This remuneration is an expense for the firm.
So, debit realization.
Yes. Debit realization account because it's the cost of dissolution for the firm, and credit the partner's capital account because the firm now owes them this $10,000. Entry. Realization Act Dr. 10,000 to partner's capital ACR $10,000.
Okay, that's the firm recording its expense. Now, what about the actual expenses? Let's say the actual expenses the partner incurred were only $8,000. Does the firm record that $8,000 anywhere?
No, because the partner agreed to bear those expenses personally. Whether they were $8,000 or $12,000, that's the partner's problem, not the firm's, according to the agreement. The firm's only cost was the $10,000 remuneration.
Right, but what if, just for convenience, the firm actually paid that $8,000 expense directly from his bank account, even though the partner was supposed to bear it?
Ah, okay. If the firm pays cash for an expense that the partner was supposed to bear, the firm needs to get that cash back from the partner, effectively. It's treated like the firm paid the partner's personal bill.
So, like drawings, you debit the partner's capital.
Exactly. The firm paid $8,000 it shouldn't have, reducing its bank balance. It recovers this by reducing the partner's capital claim. Entries to the payment made by the firm but borne by the partner. Partner's Capital Act Dr. 8000 to Bank HECR 8000.
Brilliant. So the realization account correctly shows the firm's expense, the $10,000 remuneration, and the capital bank accounts correctly show the cash movement where the firm paid something on the partner's behalf. The separation is key.
It keeps the accounting clean and reflects the agreement accurately.
Okay, just a couple more tricky bits before we close the books. What about unrecorded items? Assets or liabilities that weren't even on the balance sheet but suddenly appeared during dissolution?
Happens all the time. You find an old typewriter in storage nobody knew about, or you suddenly recover a debt you'd written off years ago.
So if you sell that unrecorded typewriter for, say, $500 cash.
Treat it just like any other asset sale, even though it wasn't transferred into realization initially. Cash comes in, so Bank Act Dr. 500, and the gain arises from the realization process, so realization ATCR 500.
Basically, any unexpected cash during realization gets credited to the realization account.
Correct. And similarly, if you suddenly have to pay an unrecorded liability, maybe an old supplier sends a bill you'd forgotten the cash payment is debited to realization account. Realization App Doctor to Bank HER.
Okay, captures all the financial effects, right? We've sold assets, paid liabilities, handled partners taking things, dealt with expenses, found hidden treasure. Now we need to actually close everything down. What are the final steps before we calculate the realization profit loss and pay the partners?
Good question. Before balancing realization, we need to clear out any remaining items from the balance sheet that didn't go into realization. Primarily, accumulated profits reserves and accumulated loss fictitious assets.
Like the general reserve, or maybe a workman compensation reserve that has a balance left over after settling any claims.
Exactly. These represent undistributed profits belonging to the partners. They need to be transferred directly to the partners' capital accounts, credited in their profit sharing ratio, General Reserve Act Doctor, WCR Act Doctor, to partners' capital acts, individually, CR.
Clears those reserves off the books and gives the partners their share. What about the opposite things, like a debit balance in the profit and loss account shown on the asset side?
Those are fictitious assets representing accumulated losses. The partners have to bear these losses. So these accounts are credited to close them, and the partners' capital accounts are debited in the PS ratio. Partners' capital acts individually, Dr. to Emanuel account, Dr. Bal, CR, to deferred revenue X, CR, etc.
Okay, reserves credited to capital, losses debited to capital. Now, what about that partner's loan we kept separate earlier?
Right. Remember, Section 48, partner loans are paid after third parties, but before partner capital. So assuming there's enough cash after paying external debts, the next step is to pay off any partner's loan.
And the entry for that, it doesn't touch realization.
Correct. It's a direct settlement between the firm's bank and the partner's loan account. Partner's Loan Act Doctor to Bank Acts VRR.
Pays off that specific liability. Okay, now we can balance the realization account, transfer the profit or loss to capital, and then the very final step.
The final settlement of the partner's capital accounts. After all adjustments, opening balance, share of reserves, share of losses, share of realization profit loss, assets taken over, liabilities assumed, cash brought in for deficiency. Each partner's capital account will have a final closing balance.
If it's a credit balance,
the firm owes the partner money. The firm pays them off. Partner's Capital Act Doctor to Bank AKR.
And if, after everything, a partner has a debit balance.
If it's a debit balance, and assuming they're solvent, unlike Garner versus Murray situation, the partner owes the firm money. They must bring in that cash. Bank Act Doctor to Partner's Capital AKR.
And this is the magic moment, isn't it, if everything has been done correctly?
The total cash paid out to partners with credit balances, plus the opening cash bank balance minus cash paid for liability expenses, plus cash received from assets, plus cash brought in by partners with debit balances, should mean the bank account balance, it's exactly zero.
The final check. Total cash inflows must equal total cash outflows, and all accounts except bank, which is now zero, are closed. Dissolution complete.
That's the goal. A perfectly balanced closure.
Wow. Okay, so stepping back, what's the big picture here? Dissolution of a firm isn't chaos, it's Well, it's a highly organized, rule-driven process.
It absolutely is. It's about closing that economic relationship in a structured way, making sure every asset is accounted for, every legitimate debt is paid, and everything happens in a specific, legally mandated order, primarily thanks to Section 48.
We've seen that strict legal line between dissolving just the partnership versus dissolving the whole firm. We've walked through the 5 ways a firm can legally end, and we've spent time in the accountant's engine room, the realization account, seeing how it measures the financial success, or lack thereof, of the winding up.
And those key rules, Section 48's payment hierarchy, Section 49 separating firm and private debts, Garner versus Murray for insolvency, and the specific mechanics of the realization account and its exceptions, they're all designed to ensure fairness, especially to external creditors, and provide a clear path to closure.
That hierarchy really is fundamental, isn't it? Third parties, partner loans, partner capital, everything flows from that.
It underpins the whole settlement process.
Right. So now that you, listening, hopefully have that strict order of payment crystal clear in your mind, here's a final challenge for you to think about. A little scenario to wrap up this deep dive.
Okay, imagine the firm completes its realization process. All assets sold, all expenses accounted for. The final cash available in the bank is, let's say, 100,000 rupees.
Now, looking at the liabilities, the firm owes external creditors a total of 60,000 rupees, and partner A had previously given the firm a loan of 50,000 rupees. Forget capital for a moment, just those 2 liabilities.
So 100,000 cash available, liabilities are 60,000 creditors plus 50,000, partner A's loan equals 110,000 total. Uh-oh, not enough cash.
Exactly. So applying the Section 48 hierarchy strictly, how much cash do the external creditors receive, and how much cash does partner A receive for their loan?
And think about the implication. If partner A doesn't get their loan fully repaid, what does that mean for their ability to get any of their original capital investment back? Why is sticking rigidly to that Section 48 hierarchy so vital, especially from the perspective of those third-party creditors?
That's your deep dive challenge for this week. Mull that over.
Thank you so much for joining us for this deep dive into the dissolution of a partnership firm. We are Adam and Grace, your guides from School on X.
See you next time for another exploration.